When Genius Failed. The Rise and Fall of Long-Term Capital Management by Roger Lowenstein details the dramatic collapse of long-term capital management. A highly successful hedge fund managed by some of the brightest minds in finance, the book provides several lessons on risk management, market behavior, and the dangers of overconfidence. Here is a step-by-step summary of 14 key lessons from the book. 1. Beware of overconfidence. Recognize that having a high level of intelligence and sophisticated models doesn't guarantee success. Overconfidence can lead to taking on excessive risk. 2. Importance of risk management. Implement robust risk management practices. Diversify investments and avoid leveraging too heavily on a single strategy or assumption. 3. Understand model limitations. Accept that financial models are simplifications of reality. They can fail under extreme market conditions. Constantly test and question the assumptions behind models. 4. Leverage can amplify losses. Use leverage cautiously. While it can amplify gains, it can also magnify losses and lead to catastrophic outcomes. 5. Market liquidity is crucial. Ensure liquidity management. In a crisis, the lack of liquidity can force the sale of assets at unfavorable prices, exacerbating losses. 6. Contingency planning. Always have a plan for worst-case scenarios. Contingency plans should include potential market disruptions and extreme events. 7. The fallibility of financial genius. Recognize that no individual or group, regardless of their intellect or past success, is infallible. Markets can be unpredictable and ruthless. 8. Herd mentality and systemic risk. Be aware of the systemic risk posed by herd behavior in the financial markets. When many market participants follow similar strategies, the risk of collective failure increases. 9. Importance of regulatory oversight. Understand the role of regulatory oversight in maintaining market stability. Excessive deregulation can lead to systemic risks. 10. Transparency and disclosure. Maintain transparency and proper disclosure of investment strategies and risks to stakeholders. Lack of transparency can lead to mistrust and panic. 11. The role of central banks. Acknowledge the critical role central banks play in managing financial crises. Central bank interventions can sometimes be necessary to stabilize markets. 12. Crisis management. Develop effective crisis management strategies. During a crisis, timely and decisive action can prevent further escalation of problems. 13. Ethical considerations. Uphold ethical standards in financial practices. The pursuit of profit should not come at the expense of ethical considerations and regulatory compliance. 14. Continuous learning and adaptation. Emphasize the need for continuous learning and adaptation. Financial markets are constantly evolving, and staying informed is crucial for long-term success. These lessons underscore the importance of humility, caution, and preparedness in financial markets. They also highlight the potential consequences of neglecting these principles, as demonstrated by the rise and fall of LTCM.